Hello traders and investors, Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, the S&P and the Qs moving a little bit lower. The past 2 days of bounces were really nice, but today taking a little bit of a breather. The S&P unfortunately not able to crack new all-time highs. The only version of the S&P cracking new all-time highs is the equal weighted SPY. As once again, the Qs have a heavy weight in the index too. All the technology stocks not performing the best today, and you can see from the big tech list down here, most of them indeed today were down except for Tesla and Netflix, but the rest of the crew kind of coming down a little bit. Now the markets didn't open too poorly. Matter of fact, the S&P and the Qs were green for most of the day, but we got a slow fade into the end of the afternoon. So in today's video, we got a lot of things to talk about as per usual. Number one, we'll be going through a couple earnings reports that came out today. Those will be Robinhood, Spotify, and S&P Global. S&P Global, the latest casualty in a somewhat unwarranted earnings sell-off. That stock was down 9% after their earnings to end the day, but at one point in the pre-market was down as much as 18%. So we'll be covering those three earnings. Shout out to everybody else who had earnings today, but we only have time for just those three. Tomorrow should be a very interesting day as well, as we'll get to cover Shopify and a couple more. After we're done our earnings presentation, we will get right ahead into our technical analysis portion of the video, run down through the SPY, the Qs, and most of your subsectors in the market. Thereafter, we will take a look at our big tech list right here, because after a nice little red day like today, do we still have some good opportunities across the board here for either some trades or some long-term positions, or should we be a little bit more cautious in this current very choppy market environment on the SPY and the Qs? Towards the end of the video, of course, we will take a look at our infamous biggest gainers and losers of the day, of which, as per usual, there were very many names big red today, but also many names big green today. So I'll be giving you guys some of my favorite picks across that list and derive any possible trade opportunities or long-term investment opportunities therein. So it should be a very fun video, guys. Let's jump right into the action, of course. So the S&P down 0.26, the Qs down 0.46 on the day, and the heat map was very mixed across the board. Kind of more of the same that we saw a lot throughout the month of January, right? Tech, unfortunately, faltering a little bit today. The financial institution segment here, very mixed. The banks were down. Credit card players were up, and the rest was very mixed. Of course, this one took a big hit when you got that report by SPGI. SPGI was down 10 on the day, but I mean, look at the other damage, right? Even Moody's Corporation was down 7% today. MSCI, another super solid quality company, was down 8% on the day. Healthcare, a bit of a mixed day as well, but some of the outperformance came, once again, from the bottom half of the market. Industrials, real estate, utilities, materials doing quite well. And consumer defensives, for the most part, there were more advancing names than declining names herein. However, the heaviest ones of the bunch, Coca-Cola, Walmart, and Costco, coming down, which did lead to a bit of downside there too. Onto the one-day relative performance, you can see that even better. Once again, the boring sectors of the market outperforming the rest. Utilities, real estate, basic materials, and cyclicals, to name just a few. And defensives, financials, communication services, healthcare, technology to the downside. On the 1 week relative performance, guys, things don't look so dire. After the last 2 days worth of bounce and today's slight little decline, we are still green on most of the subsectors of the market, led by the boring ones: real estate, industrials, energy, and basic materials. Technology is kind of right there in the middle. The ones that haven't been doing too well, though, consumer cyclical and communication services. I'll remind you, communication services is largely Google, Meta, and then Netflix for your third largest one in there. So a bit normal movement right there. Into the fear and greed index right now, we're currently sitting at a 46, which is very neutral, very soft, not much momentum in the market right now either. And we do have something to look out for tomorrow, which could bring some spiciness into the markets, which is your non-farm payrolls. This is going to be the biggest news release of the week, in my humble opinion. The expectation is for 70,000 jobs to be added versus 50,000 last month. If this number comes in substantially below the estimate, the market's really not going to like that, right? But if it comes in slightly weaker than expected, well, the rate cut probabilities are going to like that, but we'll have to see how the market treats this one. It could be a volatile session either way, so please keep that in mind. And then Friday, we wrap it all up with the CPI for another slight volatility event in the market. 2.5% year over year for the CPI is the expectation versus the 2.7% print that we got just last month. But you guys know me, I like to look at trueflation, and trueflation right now is still very low, 0.74, super low. A whole bunch of categories, guys, coming down into your good old disinflation territories right now. So this one measures 15 million products on a daily basis, which is why I love it very much more than the CPI or possibly PCEs, which don't have a fully representative basket of the overall economy in terms of goods and services, right? This one is more broad, so I trust it a little bit more. So keep that in mind. The week is not done yet, only Tuesday, and we're coming into two of the biggest news prints for this upcoming week, so please keep that in mind. Now, in terms of your overall market breadth, that was not really too bad, guys. Just low momentum right now, but nothing is really falling off a cliff. Percentage of stocks above their 20-day EMA is at a cool 56%. Not super disastrous like we saw last October, but not also super overbought either. Right there in the middle, which shows room for expansion. Percentage of stocks above their 50-day EMA also at about a 60% read. That's very good, guys. It's toward the top end of what you would expect to see healthy markets, right? Not quite super overbought and not disastrously concentrated like we were back in the month of October. And then percentage of stocks above their 200-day EMA. This one's fine, 63% right now, which is roughly equal to some of the best periods that we had in both 2024 and very early 2025 or even mid 2025 before the markets got very concentrated and took everything down late October and November. So rotation is still decent. The market breadth is still decent, but you do have a bit of a lack of follow-through momentum on both the SPY and especially the QQQs, right? We know that last week and the week prior, you got a lot of big tech names that sold down after their earnings. They've mounted a little bit of recoveries from their lows, but still no blasting uptrends, right? And you can say the same thing across many tech names, many growth names out there in the market. Sometimes for a couple days, you see some signs of life of their former glory, and then they just kind of slowly fade again. So there's just a lack of momentum follow through in the markets right now, but that's okay. If you take a look at the underlying market internals, such as the market breadth and just the overall price action that we're seeing right now, no major red flags in my humble opinion, and that is also supported by some very bullish macro tailwinds for this year. The GDP print should be very strong. We are in a rate cutting environment with the end of quantitative tightening. You are still in an environment of low unemployment. You got very low inflation, in my opinion, too. Earnings were very strong. We gave the statistics yesterday. Mid-70s percentage, like 75, 76% of all companies that have reported so far are beating on revenue and beating on EPS estimates. So earnings are very strong, and the guidance is indeed quite good. The AI megatrend is quite real, although if you take a look at the price action, you might think it's stalled, but there's a whole bunch of money going into this trade for sure. And then, of course, we are in a very nice fiscal environment right now with $4 trillion in tax cuts. So, you know, the internals are looking good. The broad-based macro is not looking too bad either. Just a lack of momentum, lack of follow-through. It's a perfect accumulation phase for the long-term portfolio investor that's looking to pick up high-quality companies at discounts and, you know, has a long-term time horizon and isn't super impatient to see, you know, gains in very short amount of times. But if you're trying to directionally trade, this market has been somewhat choppy, right? It's also a good market for farming some premiums, right? So option sellers really enjoy this market. Long-term investors really enjoy this market. The people who don't enjoy this market are probably people who do a lot of momentum trading, right? Because the moves have been somewhat quite choppy, and it is totally understandable, right? Because the indexes have been kind of trapped in a range here, largely since the month of October, so keep that in mind. Now, before we get into more technical analysis, guys, let us dive right into our earnings presentations. And we're going to start it off with arguably the most fun one of the bunch. And we're going to talk about good old Robinhood. So we all know that Robinhood has come down somewhat tremendously over the course of the past few months, as Robinhood has been very closely linked to the sell-off in crypto. Matter of fact, if I just overlay a chart of Bitcoin versus the chart of Robinhood, you will see that for the most part, the moves are almost identical, right? When Bitcoin goes down, Robinhood goes down in tandem. And the contrary is also true. When you had that nice period of expansion in crypto last year, Robinhood kind of outpaced a lot of the Bitcoin moves, that being said. But now it's been very closely tied into crypto. So our analysis today will be one where we seek to understand whether or not this sell-off is warranted and whether or not the company deserves to be so closely tied into the price action of the crypto trade, or if they have many more things going for them. I mean, quick little tip, they do have many things going for them. That being said, in the after hours, you will see that the Robinhood stock is unfortunately down approximately about 6-7% right now after their earnings report. And although they presented really good year-over-year numbers, it's a question of they missed on a lot of key elements for this quarter specifically. And also, they were facing very tough comparable numbers from the record blowout quarter that they had in Q3. That being said, let's look at the numbers really quickly. So EPS beat by 4.61%, but the revenue fell shy of expectations by about 5.3, and thus you do get your sell-off. So taking a look at some of the numbers on Robinhood right here, for the quarter, you will see that they missed on quite a few elements. The misses weren't that substantial, but they were misses enough to bring the stock down, right? So total revenues, we talked about the miss. However, as I said, the current quarterly numbers may have missed the mark, but the year-over-year numbers in terms of gains are still staggering. It's just they were facing tough comparables from last quarter. So total revenues were up 27% year over year. That's a very good number in absolute terms. Transaction-based revenues was up 15% year over year. Net interest margins were up 39% year over year, or rather net interest income, which is a very large revenue driver for them as well. And other income was up 109% year over year. But many of those elements did miss the mark on the quarterly estimates. Funded customers was largely flat to a slight miss. They were supposed to come in at 27.1. They came in at 27 million funded customers. That was still an increase of 7% year over year, which is quite good. Assets under custody, 68% year over year, despite missing on the quarter. And this was a fairly big miss, 9%. Versus the estimate, right? Still a great number on year-over-year comparables, but this is just not going to do it for Wall Street when you know that this quarter they're being very picky with earnings releases from all these companies, right? Gold subscribers was also flat. How versus the estimate, however, up 58% year over year. So you can clearly see the business is growing a lot on year over year numbers, right? Adjusted EBITDA also a slight miss. The EBITDA margins also a slight miss versus the expectations. And it's just not good enough for the company if you're looking to see a 5, 10, 15% pop after earnings, as many people got used to in late 2025. EPS as well, that was a 3% beat on the quarter. However, down year over year 35%. So let's take a look at some of Robinhood's slides, and I just want to illustrate the point here that the business is growing really well, and that is the fact over many different aspects of it. So if you took a look at the total funded customers here, guys, it's growing but somewhat decelerating, right? Still 1.8 million year over year, but just not that much sequentially quarter over quarter, which is what Wall Street was looking for. Robinhood Gold subscribers continues to remain a very good point for the business, 4.18, and you can see the take rate has been improving, which is these green little circles right there. The take rate is now 15.5%. Of all Robinhood members who then convert into gold subscribers. So that was very good. Total platform assets, this is one disappointment for the company. You can see it's sequentially lower from last quarter. Q3 was just such a good quarter across all metrics. That was a bit of a disappointment. And also net deposits was down in relation sequentially to last quarter, which was a blowout, right? Still 19% growth year over year, but sequentially lower. So that's going to be a lot of the themes that you're going to see in this earnings report, is that quarter over quarter, everything's going to be a little bit lower on some instances that really matter for Wall Street, but year-over-year comparables are still very good, right? Total net revenues, you can see sequentially flat, which is not what they wanted to see, but year-over-year was very good. If you take a look down here, net income was very strong here, guys, $605 million, giving Robinhood a very strong net income print on the current quarter. You can see I have it listed right here. Your net income right here is 47.2% net income margins, which is just phenomenal for this business overall. If we move down a little bit further, we know that Robinhood is working on many different things, right, in terms of 2026 priorities, their prediction markets, the Super Act design, Cortex, which is their AI integration in terms of stock market research and things of that nature, and then social trading, where you're going to be able to track other people's portfolios and possibly either copy them or be inspired by them. So very interesting thing that they're working on for 2026 overall, and of course working on eventually getting their banking suites up and running too, but that is going to be later on this year and even into 2027. So funded customers, as we said, remains very strong overall, not too bad here, up and to the right, which is exactly what you want to see, but still you can see there's a bit of a deceleration happening here in the terms of the last 3 quarters, quarter over quarter metrics, of course. Total platform assets, this was the disappointing metric, and you can see here, guys, right? In terms of your equities was a nice bump, but nowhere near the blowout that they had Q3 versus Q2 when they jumped it up to 203 versus 160. Now it's at 212, which was good. That's a sequential change of 4% quarter over quarter. Year over year was phenomenal though, 62%. But take a look at crypto, right? And this is one of the pain points for the business right now. Year over year change is still 13%, but sequential quarter over quarter, guys, that's down 22%, just not good enough, right? And then net cash held by users, of course, maybe they deployed, but that was up 5% year over year, but down sequentially by about 18%. So missing the mark right there on a few key metrics, namely crypto, and then the option or the equities lift just wasn't that much sequentially quarter over quarter, but still good prints by them. Robinhood retirement accounts under custody, strong, and this is a push that Robinhood has been trying to make in terms of diversifying themselves away from the narrative that they're just a trading platform and to more of a investing platform where people keep their even retirement accounts on the platform. This was up very nicely. Net new additions of our total Robinhood accounts and the accounts under custody, right? The assets under custody, a very cool 26.5 billion. So very strong mark right there. So Robinhood continues to grow in a diversified fashion, diversifying their offerings and diversifying the style of customer that it does attract to the platform. You can see here the Robinhood Gold, very healthy numbers. Nothing much to say here. Take rate is getting higher, which is exactly what you want to see as it is a premium service. 15.5% is now the new take rate for there. Pretty good. Net deposits, however, another disappointing metric for the business, but this one can sometimes be lumpy on a quarter-over-quarter basis, but still, right? This is one of your lower annualized growth rates that you've seen at least since Q4 of 2023, right? Net new deposits, only 19% growth on a year-over-year comparable. Not the best and down from sequentially last quarter, 20.4, now down to about 15.9. They're still adding, but the growth rates, right, are a little bit shy of the expectations, or at least shy in terms of what we had previously. Now, they do say they continue to gain market share over time. Their equities market share now up to 1.11%. Not the strongest, but definitely up. Options market share up 70% to 7.5% of all options traded will be on the Robinhood platform. That's a staggering number, right? Crypto market share, 1.24%, but we know the crypto market is very fragmented between decentralized exchanges and then these brokers specifically, right? Their margin market share continues to increase as well, but still, there's a lot of room to expand here by Robinhood, in my humble opinion. Here are your trading volumes, which are also very important for our analysis. Equity notional volumes were up 68% year over year. Strong number, 10% quarter over quarter. That was pretty good. Options contracts traded 38% year over year and 8% quarter over quarter. Very good as well. And then crypto notional volumes, right? So you will see that crypto notional volumes from Q3 2025 down here towards Q4, that was a bit of a decrease. Now, they did get the acquisition of Bitstamp through, obviously, which does help them in their total volume number, but still, on the legacy Robinhood platform, you are down a little bit there as well. So we once again reference the flat revenues sequentially quarter over quarter. So that is the little bit of a problem for them. And additionally, guys, in terms of your net interest revenues, right? This was the one that was a bit of a pain point for the business. I mean, in green, you got your transaction-based revenues, which were up 15 year over year and 6% sequentially quarter over quarter. But I mean, your net interest revenues, they were down, right? Q3 was such a blowout quarter for the business across many metrics. So the comparable numbers are very tough to beat, that being said, yeah? So 39% year over year, net interest income, very strong, but quarter over quarter, down 10%. You would love to see a smoothing out of this chart over time, but it's not the first time that Robinhood has come down sequentially, right? As long as they're growing in the long run, that's what's most important. But if you're wondering why the share price declined today in the after hours, it is largely those sequential numbers, so please keep that in mind. A lot of further weakness in terms of crypto here. Transaction-based revenues, right, on crypto. Very good quarter, last one, but then this one kind of a little bit lower there. However, you did have very nice other performance in other, which does include their prediction markets, which is a very strong point for the company. Equities and options continue to be a little bit more smooth than their total crypto offerings overall. So please keep that in mind, right? Crypto representing right now, you know, arguably in the, depending if you're looking at transaction-based revenues or total volumes, anywhere between the 20-30% range for the business entirely, which is why it has been so closely tied to the price of Bitcoin, essentially, right? Because they do have a good portion of their revenues and also transaction volumes that come from the crypto cohort overall. A couple more slides. We're not going to do too much, but just to say that their operating margins, their net margins have been improving drastically here over the past year. Diluted share count, you know, diluted share count is not really moving. They're buying back some shares, they are, but they're also issuing stock-based comp, and they kind of offset each other somewhat perfectly, right? So your basic and diluted share counts remain roughly flat because they have been doing a couple of buybacks. They authorized about $1.5 billion last quarter, and they've been buying back about $500 million per over the course of this quarter, if I'm not mistaken. So not too bad. The net income print was really the highlight of the quarter quarter overall. So, I mean, the rule of 40, also one of the last slides I want to present to you guys, right? Rule of 40, still substantial here at 108, but far cry from the 131 that we saw last quarter. It was such a good quarter, last one. This one shortly, sadly falling short of the record highs, but still 108% rule of 40 in terms of total revenue gains and percentage year over year, and EBITDA margins. Very, very strong, guys. You would be hard pressed to find many companies over that 100% mark, right? So very decent right there, returning $100 million to shareholders overall, and the past few quarters returning, as we said, right over the year, about just over, let's call it between $500 to $600 million to shareholders, right? With about $590 million left to deploy. So all that being said, guys, it wasn't that bad for Robinhood. Really not that bad, but you saw the common themes, right? Great year-over-year numbers for the most part, but sequential quarter-over-quarter was down, and obviously the crypto division weighing on the business as well. So what is the final take on this business? Now that Robinhood stock is down roughly, I mean, let's call it with the 7% drop, roughly 50% from the all-time highs, is it finally a buy? I mean, people were kind of scrambling to buy this stock during the later part of its rally into the second half of 2025. And as of the most recent 6 months or so, it's just been wildly out of favor as it has really tracked the price of Bitcoin to the downside. Now, some people might argue that that's not fair because they're working on so many different things, and I've labeled them right here. The additions of short selling, social trading, the Bitstamp acquisition, which is crypto, the banking push that they're going to make, their international expansions that they're underway with, expanding into Indonesia recently, right? Prediction markets, Cortex, tokenization, all things that management really loves to discuss on the earnings call. That being said, guys, right? If we're taking a look here at the valuation, because at the end of the day, it's all about what price are you willing to pay for this company, right? Around 80, where they're trading in the after hours right now, it's a 31 forward price to earnings. Not too bad. You might remember me saying that Robinhood up here was dearly expensive, and now it's actually fair in my humble opinion. The PEG ratio right now is sitting at a very cool 1.41. Price to sales is still a little bit high for me, 13.67. They're growing revenue and EPS on average of about 20.5 on revenue per year for the next couple of years, and EPS 22% per year as they do expand more and more offerings. Everything's looking pretty good for Robinhood's landscape. It's just the stock has lost all of its momentum, right? If we're taking a look here at just some fib retracements, because they didn't bother setting much areas of support on the way up, you're currently almost retracing the full 618, and we don't really have much in the ways of support because the bulls, let's be honest, they didn't really bother setting much support levels on the way up. It was just kind of buy at all costs, heavy momentum to the upside. So that being said, Robinhood right now, it's very tough for a technical trade because we do not have any bottoming cues, right? We don't necessarily have the new formation of a daily uptrend. It's just a daily downtrend right now. It's a weekly downtrend as well. And also the monthly momentum is kind of shot, although they are looking for a monthly higher low. And the 26 EMA would be a very nice monthly location to start it off with. And as we said, right, it's coming right down there into the 618 fib, which is usually the location that you're looking for a deep retracement to possibly rebuild any positions that you might have taken profit on at the top. So although there are no short-term trade indications for me right now, no clear support levels, no clear trend changes or whatnot, well, this one for a long-term investment is not that bad. But keep in mind, when I do say long-term investment, we're talking like the next 3, 5, 7 years type of thing. You can make an argument that Robinhood is fairly priced down here, and you can make an argument that it would be interesting to start to buy the dips through this 80 location, right, all the way down to possibly the 60s, right, would be a very nice place to build a position back up, in my humble opinion. If you enjoy this company, you enjoy what they're doing, and you do believe in their growth in the future, not too bad in terms of fundamental locations in Robinhood stock overall. You just got to be a little bit careful if you're trading this one because they haven't really bothered to set any support levels here, and they haven't really changed any trends. So keep that in mind if ever you're looking for a quick snapback recovery trade on this one. In my opinion, until that correlation breaks away from Bitcoin, well, Robinhood is just going to be at the whim of the rest of the crypto price action, at least for now, right? That works well when crypto is going higher, but doesn't work so well when crypto is obviously moving lower. So that's everything I had for you guys for Robinhood earnings. Great earnings, phenomenal company, working on a lot of different things, beautiful growth rates on year-over-year comparables. Eventually, they'll hit the law of large numbers, and these numbers will not be growing as fast, but still, 20.5% revenue growth on average for the next few years and 22% EPS, solid business, expanding across all metrics. So no major red flags in terms of the fundamental offerings of the company. That is for sure. Still many exciting things on the table for Robinhood in the future. That's company number one. Now we're going to come into company number 2, which is going to be Spotify. And Spotify, switching gears right here, was up 14.75% on the day. Very strong print from their earnings early this morning, but the stock indeed was up almost 20% at one point before slightly retracing. Now, that being said, Spotify is another company where before today, right, they were down almost 50% as well. So has this earnings changed the potential price action for the business? Is this possibly a business that you should be investing in for the long-term future? Well, let's break down the earnings and see exactly what happened here. So in terms of the numbers, guys, EPS, they absolutely crushed this EPS metric. 62% beat on EPS. Really strong numbers right there. And revenue, though, 0.17%, but it was indeed a beat. But the biggest metric of all for Spotify this quarter is the fact that they added 38 million subscribers to the platform. That is why the stock was largely up, because other than that, the beats in terms of just the overall financial metrics were a little bit on the soft side, right? Although they did beat on most things. So taking a look here at Spotify's earnings, total revenues up 6.8% year over year. You'd have liked to see a bit more acceleration in this one, but still, a beat's a beat, and that's not a bad print, all things considered. Monthly active users up 11.3% year over year. They beat on the estimates by about they were supposed to come in at 745 million, 751 million monthly active users on Spotify. Really, really, really large platform right here. Premium subscribers was also a beat, very small, but still a beat nevertheless. That increased by 8.2% year over year. Ad-supported monthly active users, a big revenue growth driver for the company, of course. That one was indeed a beat as well, and up 12.5% year over year. One of their better margin aspects of the business, of course, that advertising tier. Operating income, that beat by 9%. Wall Street really loved that one. That one was an improvement of 47% year over year. Operating margins higher and a nice increase of 4% year over year. EPS solid, as we said. That was arguably the highlight of this quarter. Free cash flow, tiny little miss right here and down on a year over year comparable number, but Spotify has never really had a free cash flow problem. They've always been able to generate very substantial amounts of free cash flow. Now, in terms of the guidance, there was a bit of a shortfall right here in terms of Q1 revenues. It was a tiny little miss by about 1.6%. Not the worst miss, but a miss nevertheless. And the guidance would provide for a 7.4% Q1 revenue estimate year over year. Operating income, the profit margins of the business remain the strong suit of the company. And this is largely also because, well, in the upcoming few quarters, they will be benefiting from a price increasing on their product, right? So moving from $11.99 to $12.99 per month, in line with some of the other people who offer premium music services. And we will talk about that at the end of the analysis when we derive whether or not this company is a good bet for a long-term portfolio, because it all has to do with their place amongst competitive peers or the competitive landscape right now. So moving on into more numbers right here, guys, you'll see that everything was pretty good, right? Total monthly active users was up 11, as we said. Premium subscribers up 10. Ad-supported MAUs was up 12% year over year. Very decent numbers. Revenue was 7. Gross margins improving. You can see that, right? Up from the lower 30 portion right here, 31, 32, 33.1 on the print right there, which is very solid. So the business executing quite well. And obviously your operating margins also moving substantially higher. You can see the past few quarters were kind of like anywhere between, well, this one 9.7, but then up to about 12, 13. This one 15.5, so a net improvement right there. So the bulk of the move today in terms of the 15% rally was really in terms of how many net new monthly active users they added sequentially quarter over quarter. 713 to 751, that's huge, right? Absolutely massive. 38 million new people to the platform right there. And free cash flow, as we said, right? Free cash flow was a bit of a decline, but still very solid and very consistent free cash flow metrics by the business overall. And they are sitting right now on about $9.5 billion of 9.5 billion euros on the balance sheet right now. So pretty good. Now, there were a few shortfalls, but it all has to do with currencies and things like that, right? So premium growth driven by subscriber gains, very strong right here. Premium ARPUs, average revenue per user, you can see it's curling back up higher after a few quarters of slight declines here, curling back up a little bit to about 5 euros. The advertising is also helping in that as well. As they say here, the advertising business transformation continues. You know, in net US dollars reported, that's down 4% year over year. Ad-supported revenue, however, constant currency does show an improvement of 4%. So not too bad. You would like to see a bit more of an acceleration there, but not too bad, right? Auction-based revenue, percentage of ad-supported is moving a decent amount higher. So that is good for the platform, but you can see the top line revenue amounts here, right? Ad-supported revenue, it's kind of flatlining right here. You would like to see an improvement there, a re-acceleration from Spotify in terms of the ad revenue being generated, right? Because most of the pricing right now is being generated by this, guys. It's being generated by net new members, okay? And also price increases, which is good, but you would like to also see them be able to further increase the monetization basis of their members, right? Kind of like Meta does on a recurring basis, to where they constantly are able to etch out more and more gains per customer, either through, better advertising and things of that nature. So keep that in mind, guys, right? It's really this premium ARPUs, right? They haven't really moved in like the last year and a half. We have an upswing, but overall, you want to see this chart expand, this blue line right here, like Meta does, a little bit better. That's the closest example that I can give you guys if you want to see really healthy ARPU growth through advertising. Moving on to gross margins, guys. I mean, the margins are the highlight of the quarter, of course. Total gross margin, premium gross margin, and ad-supported gross margins. The last 2 quarters have been very good, a lot better than we previously saw earlier this year. Operating expenses as a percentage of total revenues continues to decline, which does show the business continues to benefit from operating leverage as they scale their revenues. Their total expenses, their total expense profile is indeed coming down. And as we said, free cash flow remains very strong, very consistent for the business overall. Cumulative free cash flow is strong, but you can see, right? They're making more and more revenue, but you would like to see them increase the free cash flows at the same time, right? Now, they are reinvesting in the business, of course, that being said, but still, right, you would like to see them start to reaccelerate this free cash flow generation on a quarter-per-quarter basis, so keep that in mind. Monthly active users, there's never really been a problem right here, right? The rest of the world, Latin America and North America, all continue to do quite well overall, so nothing to see there. Premium subscribers, which is a big growth driver for them, right? Get that juicy subscription revenue. Well, also most segments of the market are indeed increasing. Europe is coming down in terms of overall percentage of the entire cohort, right? But it's good. Very broad company. So there's not much to say here, guys. To be honest with you, they're doing lots of very good things. And the guidance was also quite decent too. So we're not going to spend more time than that on, on Spotify. We've already spent a lot of time on Spotify so far. But what I did want to spend some time on, guys, is this price increase right here. $12.99 a month, because you want to determine whether or not this company has true pricing power, or whether it kind of has to match the rest of the industry. And I'll give you some metrics really quickly, right? Because when we take a look at Spotify overall, you really got to compare it against its peers. And the unfortunate thing for Spotify is that in the last 10 years, they've gotten really tough peers to go up against, right? Keep in mind, Spotify is just a standalone music platform, which there's nothing wrong with that, right? But here is what you're competing with. You're competing with these guys right here, right? Apple Music has a lower price than you, okay? And it arguably has, Spotify's integration into Apple devices is seamless, but still, right? You can make an argument for that. Apple Music is $10.99. Is Spotify's price here justified? At $12.99, you may argue, well, they have more podcasts, they have more live events, and that may be true. But in terms of just a pure music library, you might say that Spotify may have a little bit more in a little bit more niches across the space. But still, is the extra $2? Put yourself in the mind of an average consumer, right? Okay, people that don't niche down so much like that. Is it easy to justify $2 more per month for Spotify than just paying $10.99 for Apple Music? For some people, for some of you watching this, you say, well, yeah, like I'll pay the extra $2. But for the average person here, we're talking about the average person, because we want to know what's the company's pricing power, what's their total addressable forward market, or will the competition be heating up over time? Keep in mind, right? Apple has many other things going for it. Like if I'm looking to invest in Spotify as a business, only as a music platform, or I can invest in these other companies when they have so many other things going for them. These are all things you got to consider. YouTube Music as well, $10.99. But you know what the thing is though, right? YouTube Music alone costs $10.99. However, YouTube Premium, the whole YouTube Premium, costs $13.99 per month. And if you buy that, it includes YouTube Music for free. So not only with YouTube Premium can you watch YouTube videos ad-free and many other little cool things, but also you get YouTube Music for free. So would you rather pay Spotify $12.99 or pay $13.99 for YouTube for YouTube Premium and also get YouTube Music. Now you might say, well, it doesn't have as many things as Spotify. I don't like it as much. That's fine. But think of the average person once again. These are your comps. I'm just giving you guys the data, right? Amazon Music. Now, Amazon Music is a bit of a tricky one. They're arguably matched. Standard non-Prime members here are also at $12.99. Prime members are $11.99. But the funny thing with this is that Amazon Music, okay, most of Amazon Music, I would dare to say 75 to 80% of anything music related that you can possibly find, including a library of like 100 million plus songs, right, is available to Prime members for free. However, the full suite of Amazon Music, which they call Amazon Music Unlimited, is an add-on fee of $11.99 for Prime members. Most people will not need, at least the consensus is that most people do not need more, to take the Amazon Music Unlimited route. So you see what the problem is here? Apple's cheaper. YouTube has this integrated into YouTube Premium, or you can get standalone, but most people just get it included as YouTube Premium. And for most Amazon Prime members, just the existing Amazon Music that comes included in Prime, which is massive, is going to be enough for, dare I say, 90 to 95% of people out there. So as a result, when we compare Spotify, yes, the numbers are phenomenal on their own. Yes, they've sold off substantially from the highs, but can you truly say they have pricing power? Unless Amazon, Apple, and YouTube raise their prices, can Spotify continue to raise their prices on their own to generate pricing power? No. So where's their growth going to come from? Their growth has to come from growth in ARPU, which we saw was flat, right? They need to learn how to monetize their user base better and do advertising a little bit better in terms of monetizing those users. And they also need to keep growing the platform. Now, keep in mind, Spotify, as we showed currently, right? It's a very solid business, but keep in mind, they already have 750 million active users. What is their total top? What is the top of that market? Eventually, when you stop growing users or it kind of plateaus and your ARPUs, average revenue per user, isn't peaking as well, then you're left with pricing power, right? That's the only other way you can drive top line revenues, right? You either add more users, you're able to monetize your users better, or you just increase prices. And the point that I'm making lastly here is that unless these other players, which are their competition, increase prices, Spotify can't really justify any further price increases, can they? So that is the counter argument for buying into Spotify right here. Now, arguably, if you have a very low cost base on Spotify, there is no reason to sell. However, when the stock is trading right now at about $480, and you're talking about a stock that trades at a forward valuation of a 33 forward price to earnings ratio, they are growing revenue and EPS at very nice clips on average through 2028. Nobody is doubting that, right? And I do agree. Now, that being said, though, at 480, it's a 32.8 forward price to earnings. It's also a 1.5 peg. Price to sales is about a 4.2, and the trailing 12-month free cash flow yield is above a 3. But just take a look at this peg ratio, right? How much are you paying for the forward growth of the business? And then compare this to other businesses, right? Because the PEG ratio allows us to compare apples to oranges, allows us to compare different businesses, a lot of them across different cohorts of tech, right? Okay, so I mean, they're cheaper compared to Apple because we know Apple's PEG ratio is closer to 3. But what about the other ones, right? What about the other ones? Well, Amazon, for one, which is a far wider business in my opinion, they trade a 1.35 PEG. So Amazon is, on a PEG ratio basis, cheaper than Spotify, and also on a forward price earnings ratio basis, cheaper as well. And both companies are growing EPS at about 20% per year, right? And Spotify is growing that about 22% per year. So Amazon is de facto cheaper than Spotify at these prices. If you take a look at Google, although Google has rallied substantially, right? Google is indeed more expensive than Spotify, but there was a long period of time where it wasn't, right? So that being said, you have a choice. There's a whole host of other companies that we cover on a regular basis that trade at PEG ratios cheaper than Spotify. I mean, just take a look at Meta right here. Meta trades at a 1.17 PEG. They have better ARPUs. They don't have a streaming service or whatnot, but in terms of if you're talking about monetization of ads, which is a portion of Spotify as well, you got Meta here at a 1.17 PEG, right? You got Microsoft here at a 1.34 PEG, et cetera, right? So those are your comps. So knowing that we have only limited amount of capitals to inject in the money at any given time, Is Spotify a great long-term investment? Well, I guess this all has to do with your personal taking on the company, right? Your personal penchant towards liking the business or not. I think it's a phenomenal business, and I think they do have a lot of growth possibly ahead of them as well. I don't think that the prices up here, $7.50, would be the absolute top of Spotify as a stock in the overall markets. However, the lack of pricing power here versus sector peers, and arguably the fact that they've kind of locked themselves into only music, whereas Amazon, as a Prime member, you get so much more than that. Apple has a cheaper price, and YouTube Premium also you get more than just music with YouTube Premium, right? It's a tough ask for me to invest in Spotify as opposed to some of these other businesses, especially after other recent sell-offs. Now, it would be a different question if a lot of the big tech names would be trading at two pegs at record highs, and I was looking for a high-quality business that sold off a ton at a decent valuation. Then I can make a compelling argument that, well, maybe I can rotate some profits into Spotify, and it would make sense, right? But currently, with the amount of other discounts that we have in the market on companies that arguably have much wider moats and just more offerings as part of their business models, it's a tough buy for me, but I totally get it. If some of you guys are invested in Spotify, good quality business, compounds revenue, compounds EPS, good free cash flow yield, they're growing their user base, and their platform is very solid. I've used Spotify many times, right? Coming down to the 200 weekly EMA, a nice little discount here. So on paper, it would be a time to buy on Spotify. But the question you have to ask yourself is this the company that you want to own for the next 3, 5, 7 years in light of everything we've presented today? Or would you prefer another tech company with a more diversified suite of offerings? That choice, at the end of the day, is yours. Moving on, that is everything we had for Spotify. Great business, fair share price right now, in my humble opinion, but the competition does remain, right? Moving on to our business number 3, SPGI. SPGI, the latest victim in the SaaS sell-off. Now, not too long ago, and I'm talking like literally 2 weeks ago, 3 weeks ago, stock was $531. Past 2 weeks, down 25%, and today's earnings definitely did not help that, right? Now, why did SPGI drop so much? I mean, if you can see here, in the pre-market, it was down to $360. From where they started to the bottom here, that was a 20.5% move. For a company that otherwise usually can barely even move 2 to 3 to 4% on most of its earnings presentations, right? SPGI, Moody's, and a whole host of other long-standing compounding companies with strong moats, strong business models, they have been moving like high beta momentum stocks. And it's all because of AI. But you know what's funny about AI? You know, the fact that supposedly Claude is going to replace, every single business under the sun that has ever used the internet, pretty much. You know what's funny about a lot of these businesses, right, is the fact that a lot of people don't understand. The market is very irrational sometimes in the short term, but, people say that SPGI's business can be replicated with AI. Well, at least that's what I assume the price action would tell you, right? That's actually not the case, right? When you think of Claude and ChatGPT and things like that and Gemini, all they do is just search databases. But there's people that have the proprietary information, right? People who collect the actual information from the market. And that's a company like SPGI, but it's a wide moat business. It has many different aspects to the business. There's the indices business. They do own the S&P, and they also do own the suite of Dow Jones products, the massive indices business for them. Number 2, they're one of 3 rating agencies on the planet that are worth their weight, pretty much at this point in time. Only 2 are 2 of the major ones, right? Moody's Corporation and SP Global, they control most of the market in terms of ratings. So that's a toll booth aspect of the business. But then there's the whole market intelligence aspect, which people have criticized, saying, well, AI is going to be able to do that. Well, no, actually it can't, right? And S&P Global told you that literally last year. S&P, this is from July of last year, July 15th to be specific. S&P Global and Anthropic announced integration of S&P Global's trusted financial data into Claude. SP Global compiles the data. Claude just regurgitates the data. Claude doesn't find the data on its own, right? SPGI has proprietary data from all its different avenues, all the different aspects of its business that it conducts the research in, or that it pulls data from, and then Claude then pulls the data from S&P Global because they now have integration. So it's kind of funny how that works, right? So if you look deep into things, you would understand that these sell-offs are largely unwarranted and indeed are buying opportunities. But I know how it feels, right? You buy these high quality compounding companies on dips, and then they start acting like high beta tech stocks and names that'll just go out of favor, right? Now, these are arguably some of the most, the businesses that are most tough to disrupt, which is why I'm a big fan of buying them. But they are by no means businesses that you are expecting very quick and rapid gains like you would in a small cap or mid cap stock. No, they're just legacy long-term compounders. And you can see here, we've now cracked the 200 weekly EMA. That's not easy to do. You need a big bear market like 2022 or a global pandemic like in 2020. 2018 never got there. When's the last time they did that prior? 2016 once. And this is just when they're touching it, right? They only cracked it in the depths of the bear market of 2022 when we were raising interest rates, because obviously S&P Global's a debt rating business, doesn't do well when rates are going higher because it benefits more when rates are going lower, so people refinance a lot of debt. Now, that being said, the last time it was under significantly the 200 weekly moving average was during the great financial crisis. So essentially what the market is telling you right now is that S&P Global, at least in price action terms, is worse off than during the bear market of 2022 in a high interest rate hiking environment, which is a disaster for the business, or a great financial crisis. So, these sell-offs, and they even drag down Moody's, but it even dragged down SPGI. These sell-offs are quite brutal, but I'm just here to say my underlying thesis on S&P Global has not changed. And I do not invest in all companies in the market, but the ones that I have in my long-term portfolio are companies that are very difficult to disrupt overall. And this one is also very difficult to disrupt, despite what the most recent price action is saying. Now, that being said, in terms of their earnings, some of the reasons for the declines, well, they missed on EPS here by 3 cents. Slight miss on EPS, and revenue was slightly soft, right? 0.19% beat, but you're never really expecting S&P Global to deliver huge beats on the revenue metrics either, right? The past few quarters, we saw 2% beats, so this one was a little bit light in terms of the revenue beat, and the EPS did miss. So that's a reason for a drop. I would understand if the stock were down, 3, 4, 5%, as it usually acts after it reports a somewhat lackluster quarter versus the estimates. It's a very boring business, right? You're not expecting massive swings in EPS and revenue as well. But additionally, if you take a look here, their guidance, Wall Street had a problem with the guidance. The midpoint of revenue growth here for 2026 is about 7.6%. That literally came in line with the estimates. The one thing that did miss the mark, though, on a 2026 guidance is the EPS profile. The midpoint here is about, $19.50 roughly, let's call it. And unfortunately, that was under the estimate that Wall Street had penciled in coming into this quarterly earnings. As you can see right here from TradingView, which was the Wall Street consensus, coming into this earnings, the estimate was $19.84. So missing this one also by not that much, right? It is a miss. You gotta call a miss when it's a miss, right? A couple of percentage points right there. So soft revenue for the quarter, soft EPS for the quarter, revenue for the year came in line with expectations. Not below, but just roughly in line, and EPS was a miss on the total year so far. So all those things combined probably should have translated to I would have understand maybe 4 to 6%, but 20.5% down for this business. Bit of an overreaction in my opinion. Let's dive a little bit deeper into the numbers and let's see where SPGI is, because at $400, guys, you're getting a very cheap deal on SPGI. I mean, the share price is back to where it was just a few short years ago at this point, call it January of 2024, but they have improved their revenues and EPS so much since that time, right? Look at this EPS profile, very consistent, and the revenue growth profile, very consistent as well. Not the fastest growing top line revenue business, but it's a toll booth company. Most of the divisions of their business are they just collect money every single quarter, every single month, right? So let's take a look at some of the damage, or some of the reasons for the damage, right? And let's see if it actually kind of makes sense, right? So full year 2025 financial performance, S&P Global Market Intelligence Division, right? 5.8%. That's what people say are going to be disrupted by Claude, despite Claude needing it to give some of the data that it outputs, right? Which is kind of funny. The ratings business up 8.1%. We're going to talk about that. S&P Global Energy, which is also an analytics division of the business. It's not like they own oil fields or things like that. No. Just information, 7.3%, and the mobility division, which will be spun off eventually because it is the, one of the lower margin cohorts of the business. That one also 8.6%, but good revenue growth right there. The indices business, S&P and the Dow Jones indices, 13.6% revenue growth, 71% adjusted operating margins right there, which gives S&P Global on a total 7.9%. The guidance for the full year given in October was 7 to 8%. You got 7.9, decent. Adjust. Look at these operating margins, man. Such solid operating margins for this business overall. And let alone, I mean, the net margins, 33.1%. So nothing is bad here. Free cash flows are also good. They keep buying back shares. There's nothing wrong with this business. It's a high quality compounding business. The numbers should appear boring to you, right? So please keep that in mind overall. Now, if we move on a little bit further here to a few of their slides, right? One of the things that you really got to pay attention to here, guys, is the refinancing study, okay? Because we know that the ratings business is a very big portion for the company, yeah? So in the next 12 months, you got a decent amount of debt maturing, but look at the debt wall that's being built up for the next 2, 3, 4, 5 years. It is a massive, massive, massive debt wall. I mean, just for the next 36 months, you're talking about, at this point, about $7 trillion of debt refinancing that needs to come up, which includes, you know, bonds, different loans, revolving credits, et cetera, et cetera. Everything that can possibly be measured with a credit rating will be up for refinancing and maturing over the next few years. So this is going to be a massive revenue portion for the company, them and Moody's Corporation, which is why we should be very bullish on SPGI and Moody's coming into the next few years. So very, very strong numbers right now. If you take a look here at in terms of some of the overall breakdowns from the various components of the business, right? So market intelligence division, solid. All aspects of it growing very solid, guys. There's nothing to see here. Adjusted profits and adjusted operating profits and expenses, very strong profile right there. So market intelligence, the segment of the business that's supposedly going to be disrupted, even though LLMs need to partner with them to have their data, which is just hilarious to me. Well, unfortunately, they got sent down, right? But this business, no problem there. Ratings business, what about them? They were up 12% year over year. As we said, adjusted operating profits, they were higher, right? Operating margins, higher, decent. And across the board here, you know, whether it's the ratings business for governments, structured finance, financials, or corporates, not too bad. Financials a little bit lower right here, but still, look at the moving corporates right here and governments as well. Very strong. S&P Global Energy, which is also just data, right? So take a look here. Decent moves overall, especially in the larger cohorts for that business too. Adjusted operating profits and expenses, operating margins, higher, right? See, this is such a high quality business in terms of the margins. S&P Dow Jones indices, right? You can see that data and custom subscriptions up 13, exchange traded derivatives was up 20, and asset linked fees were up 13. That's when, you know, whenever you pay an MER to the SPY or any number of their suite of indices, you pay S&P Global, right? Operating margins, higher again, 68.8%. Mobility division, they will be spinning off right now. They have some of the lower operating margins right here, but still a very decent quality business overall. So they'll be spinning that one off. Still no details as to when that will be given overall. So you can see, I mean, it's just very boring, very boring. And in a boring business like this, after a quarter like this, as I said, it should be maybe down 3 to 6%, in my opinion, after being in this one for years and years and years. Usually when they've given, you know, soft outlooks like this, they have dropped, you know, 3 to 6%, even 5, 6%. That's when you start to scratch your head and be like, wow, SPGI is down 6. This stock usually moves like barely 1% in a single day. You know what I mean? So that being said, at $400, guys, there's a few metrics right here that I'm just going to run by you before we kind of conclude this segment overall. Next 12-month priced to earnings, okay? It's now down at 20. The last time they were 20, the COVID pandemic, some lows of 2019. And yes, SPGI has traded at a premium over the course of the past 5 years. They're now coming down to some of the lows, some of the average lows that we've seen over the past 10, 12 years. Since 2014, this chart goes back to. So you are paying, in terms of historical prices, you're paying a cheap forward value for the company. Not only that, this is price in relation to operating cash flows. You're paying at 22.22. Also, some of the lows that we've seen here over the past 8-9 years overall. Was S&P Global potentially overvalued coming into 2023 and some 2024 metrics when they were trading at, you know, high 40s price to earnings? Yes, but they've improved the business so far. It's very cheap right now. Forward price to earnings, 20.5, as we said, roughly, right? 1.64 peg, very rare to find them there. And the free cash flow yield At 4%, you very rarely see this on SPGI. I've been an investor in this company for years and years and years, guys. My first buys on SPGI were like in 2019. So I've been in this company for a long time at this point. You don't often see these forward metrics. So SPGI, in spite of the price action, remains a buy for me. It's weekly oversold conditions. It's daily oversold conditions. Yes, the monthly is not looking the best as we've kind of cracked through all the metrics. Now, that being said, 400, or even if they give us another gift down here, 363, I mean, we were saying for me, I was buying here, you know, this whole time, whenever it come down 460, 450, not huge buys, but just whenever I DCA into my portfolios once every 2 weeks or once every month, if SPGI is in that cohort of stocks that I deem to be good value, I'll just nibble a little bit at it. And I'll continue to do so down here and continue to do so down here as I do plan to hold the company for the next 5-10 years. Business model is definitely not broken, and you should be looking forward to a lot of that debt pipeline, which will have to get re-rated essentially by this business. So strong business, unfortunate casualty of the times that we're in right now. I do believe the sell-off is unwarranted, but just because it's unwarranted doesn't mean it can't go more. It just means that if it does go more, you're getting a very attractive price, guys. I mean, if you're buying S&P Global here, right, you're buying it cheaper than most people have bought it on a fundamentals valuation basis. Then most people have bought it in the last 5-6 years, and sometimes even more than that, right? So just keep that in mind. It's not a business that you should be expecting, you know, crazy Palantir last year style of gains, right? It's just a consistent business that can act as a nice backbone to a portfolio. If you guys are heavily growth oriented, you know, this acts as a nice counterweight, or at least formerly acted as a nice counterweight, because now it's just acting like a, you know, high momentum tech stock. But in my opinion, that will not last forever. So that's everything I had for you guys for our earnings presentations today. We spent a lot of time on them, I do understand, but you know, when sometimes you get some weird moves like this, it's always good to explain what's going on behind the scenes here. So hopefully you guys enjoyed all those earnings breakdowns. That's all I had for you. Now let's move into some charts, shall we? All right, moving into some charts. We won't spend too much time on the indexes because not much has moved, let's be honest, right? So S&P failing the breakout once again. If we do pull back a little bit lower into the next few days of trade, just keep an eye on the support area that's been holding us this entire time. 685 down to about 679. No real red flags in terms of the price action, just very slow movement across the board. But as long as your market breadth doesn't deteriorate, you can't really see if there's any structural or internal problems in the market right now, just sector rotation. Moving on the QQQs as well. Pay attention, guys, right? Daily downtrend, we will see. Will they be able to change the trend back to an uptrend? That being said, the bounce from the lows, decent bounce right now. It's a 618% bounce. So not too bad, but you do need to see the bulls change the trend and start to regain a little bit of that momentum to the upside. You would love to see them hold the support area, 605 down to 613. If we unwind everything, you will just be coming right back down into these new support lows, 596 down to about 589. Overall, the short-term action of the QQQs is slightly range-bound, especially if you take a look at the weekly chart, but especially the monthly chart as well, right? This monthly chart holds all the Qs. It's just been sideways accumulation, very annoying price action for the past few months, but I wouldn't necessarily say that there's any major red flags or things are breaking down in a rapid fashion. Just a very wide range of accumulation right now on the indexes with your rotation underway. On to the XLF time frame, or the XLF chart right now. Financials also not doing too much in the over the course of the past few weeks. Some days the banks run, then they pull back. Some days the credit card companies run, then they pull back. Some days the insurance companies do well, and then they pull back, right? So financials has been a little bit mixed recently, but the clearest time frames of them all are the weekly. We're still looking for the weekly continuation of the uptrend. In the event that you just break down right here, weekly downtrend, you got a huge area of defense, 52.16 to about 50. I'd be hard pressed to believe the bears would be able to get through that, especially if they were never able to make it through in all of 2025. Financials components should be looking good, and overall, you just have a bit of a daily higher low forming right now. I mean, you guys know my favorite plays, even though they may have been unfavorable. Favorite plays for like long-term investing purposes right now. I mean, JP Morgan under 300 if we find it again, decent. That was one of my possibly favorite pickups. Visa, MasterCard down here in the Visa low 300s, MasterCard in the mid fives as well, down to this pocket right here, lower fives, decent accumulation zone if you're looking to acquire some more shares for your long-term portfolio. SPGI, Moody's Corporation, there's just such solid businesses that have suffered unfortunate fates as of recently. You can see even Moody's Corporation here, they have earnings next week. They've undercut almost all the prices from mid 2024 through all of 2025, and we're quickly making our way back into the tariff candle of 2025, coming back arguably to prices not seen since, January 2024, 2021 as well, despite big improvements on their earnings. So, now's the time if you guys were on the fence, if you guys enjoy these styles of companies, right? I mean, now's a better time than over the past few years, arguably, to pick up some of these legendary, high-quality toll booth companies. So keep that in mind. Moving on to healthcare right now. Healthcare also very choppy right now. We're still trapped between about 158 and 153s, as many names in healthcare continue to be a push-pull situation. Range-bound price action right now. No break to the upside, no break to the downside. Nothing much to report right here. If you get the break to the downside for ever which reason, I'm constantly monitoring the breakdown back into 150 to 145 for a little bit of an ETF back test here, breakout, retest, and then run. That'll be a nice location if I were looking to build up my leap call positions on healthcare if I wanted to play. Moving on to semiconductors right now. Semiconductors down 0.46, but let's be honest, not much action. There was some action in certain stocks today across semiconductors, but the index didn't really move too much, yeah? So keep that in mind. We had a very big downswing right here. Nice recovery rally by the bulls, but now they got to get the trend back. They had the daily uptrend. We lost it, but this big flush right here, now we got to get it back, right? In the event that they do the infamous rollover, complete rollover, because I'm sure that's what people are nervous about, right? Just still hunting for a weekly higher low. Hunting for a weekly higher low, right? And you may be able to come back down here. 12 EMA is about 383, all the way down to the actual resistance, which could be current support, at about 370. So this little pocket of interest will be one to watch on semiconductors overall. A lot of push-pull in that area as well. But there are some phenomenal deals, and we've been talking about them for the longest time, right? Like Broadcom down here, lower 300s was a very good pickup. Comes back down there again. In my opinion, interesting to play. Marvell, phenomenal growth rates moving into the future. Here, lower 80s into 70s, also a very good pickup. AMD, we talked about it, right? Lower 200s down into the 190s. Very good pickup, in my opinion. NVIDIA, if we somehow drop a little bit more, you guys know me, lower 170s to mid 160s. Phenomenal area for this one as well. So there are many names out there that either haven't moved or that are currently in pullback areas or, range-bound price action that are quite good opportunities across semiconductors. You really don't need to look too far across that landscape. And lastly, moving into the Russell. So the Russell not performing too poorly today, down about 0.27%. They're trying to also change the trend. You got the daily downtrend going right there. Then you got a very nice bullish engulfing move. We are looking to recapture the daily uptrend to the upside. The weekly time frame shows that best weekly uptrend, very clear. You got your higher low. You're looking for the expansion. We will see what happens. But the growth stocks still looking very good. Even though it's been somewhat muted in the most recent few weeks, growth stocks still have a very nice landscape for 2026. So be mindful of those pullbacks, right? If you're looking for some pickups on the Russell, just kind of play around the 26 EMA, where the bulls have been holding it ever since those last April lows overall. The monthly time frame remains very nice in terms of overall expansion. So whether you guys are playing the Russell or individual small and mid cap names, interesting niche of the market into 2026, as the macro backdrop does favor a lot of these growth stocks into the near-term future. So keep that in mind. Moving on to other assets such as gold and silver. Well, gold and silver on the Tuesday session didn't really do too much, and even in the overnight action, we're also not really doing too much. We're trying to break above, though, on gold, 5,050, 5,060 area. This little area that the bulls have been unable to break, it's a very substantial area, guys, because if they do crack it and close above, that's your new daily uptrend, right? At this point in time, still looking for it. If we just consolidate a little bit more, pay attention, guys, to your daily higher lows, 46.53, right? So even if they stall out here, they have a chance of getting this daily uptrend back, but you still need to see it. That being said, price action is not terrible. We're just kind of in the middle right now. You're literally in the middle of the top and the bottom of the most recent moves. So that being said, the risk reward profile right now is not the most favorable, but still the gold bulls haven't lost any major time frames. It's still a weekly uptrend with your higher lows being planted. They still do look like they're in control. The monthly time frames don't look that dire either, although the RSI is very overbought. It's just very tough to position. So basically what I'm saying is that if we are long from prices previously, well, I don't really see a reason to sell right now, right? Because the long-term bulls still control all the time frames. But just starting a short-term swing trade here, I mean, you got to go with your most recent stop losses. If you're going for the daily uptrend breakout from this level, well, you got a very clear stop loss down below right about there. Yeah, because that's your daily high or low. If they lose that, it invalidates the setup. So that would be your stop loss area. Your initial take profit range would be 56, and then carry higher to about 6,000. So not too bad of a trade setup. The cleanest setup on the metals, in my opinion, because silver has not changed the uptrend, and they're not even close, right? If you take a look at silver right here, they dropped a lot more. They set the daily downtrend. Gold never did that. It was just one flush, and now they're looking to get it back. Silver, the more volatile asset, doesn't have the same setup right here. Now, you may argue that, well, if gold does it, silver could possibly carry, and that may be true, right? But still, silver in a daily downtrend, you need to see the bulls reverse the trend, okay? And weekly timeframes are not too bad, although they did come down very, very, very deep into this move. They tagged the weekly 12 EMA, they tagged the weekly 26 EMA as well, and they came very close to something that people said couldn't be done. When silver was all the way up here, it was like, no, we're never going to pull back to the monthly 12 EMA. Well, we almost did, right? And that usually always happens. It's just a question of when, not if, for the most part. So silver, not the cleanest setup, in my opinion. But still, if you're basing your trades based on the price action off of gold, well, the stop loss would be below the recent lows, and you would be targeting re-expansion towards the highs, trusting your higher time frames, higher time frame weekly bull control, and higher time frame monthly bull control. But silver will be the more volatile of both assets, and just keep in mind, you don't have the daily uptrend break confirmed on gold just yet, right? So you would be kind of leaning into a little bit of speculation more so than a raw price action. Moving on to crypto right now. Bitcoin and Ethereum, man, down yesterday, or rather today, Tuesday, almost 2% on Bitcoin, and now in the overnight session, down another 2.5. Let's just be honest with it, right? The price action has been abysmal. Daily downtrend, weekly downtrend as well, and monthly just eroding all of the gains. So they got to start everything from scratch, man. I mean, we're into support right now, 66. If they lose 66 again, well, they're going right back down to where they touched just about last week at this point in time, yeah? 60,000 and about 55 are the lows. There is no current short-term swing trade right now on Bitcoin. You don't have a trend unless you want to speculate that this is your true low and you're going for the long. Then you would put a stop loss back here and you would be taking profit into this previous resistance range up there. But it's speculative, right? You don't have the daily uptrend break. That's why I like to wait for daily uptrend breaks, because then you can enter on the break of the daily uptrend. You got a new stop loss with your higher low, and then you can actually say, all right, well, at least the bulls control something. Right now, they control absolutely nothing. It's just matter of fact, right? So that being said, Bitcoin is very, very weak still. Ethereum very weak still. The only thing that you could possibly do on Bitcoin would be a long-term accumulation trade, just nibbling on these dips. If you were looking to build a Bitcoin position that you're looking to carry on the next 2, 3, 5 years, well, these are the dips you'd be willing to do it on, right? But not calling the bottom just yet, because the price action doesn't confirm that a local bottom has been established. And the same thing can be derived on Ethereum right now. Daily downtrend, same concept as Bitcoin. Support level stay below 1750, down about 13. Weekly, also complete flush right now at the monthly time frame, just giving back all of the gains, almost all the gains from the tariff low push. Right? So it takes so long, guys, to reverse these time frames. Daily, you need days and days and days to reverse this. The weekly, if you want to reverse the weekly and say the monthly lows are in, you need weeks and weeks and weeks to set a month. I mean, look how long they tried it here, but it never happened, right? It took like 2 months to do that. And then the monthly, forget it. The monthly, you need even longer to confirm a true monthly uptrend. So Ethereum, same concept. The only thing that makes sense here on Ethereum would be a very speculative trade, saying this is the true low and going for expansion, although you don't have confirmation yet, or just building a long-term Ethereum position in the portfolio, if that's something that you've been looking to do for a while, if you believe in the long-term Ethereum thesis. That's everything for your overall market rundown. Now, let's dive into some of our big tech names. So moving into Apple right now, Apple down about 0.34%. No price action has changed right now. Still a daily uptrend, looking for a little bit of a back test right here, back testing the lows of this support box. I mean, we currently came above it. You can make an argument that they're currently using it as support, and that would indeed be true. Lower 270 is what you'd be looking out for. The weekly is looking pretty good right now, right? So they recaptured most of this weekly slide, looking for further expansion. It's getting a little bit turbulent here as we kind of try to crack through that level. The monthly time frame looks pretty good as well. You got your monthly higher low test into the 12 EMA, which was the last time that I was saying this was the time to, either buy Apple or build a bit of a swing trade position. Right now, in around these highs, not the biggest fan. Right, it is a little bit late on that trade in my humble opinion. At 270 right now, the company is Trading rich, let's just say it how it is, right? 32 forward price earnings, a 3 peg right now, but the fundamentals have been improving on Apple a lot, and we saw that. Strong net margins, tons of cash on the balance sheet, tons of buybacks in play as well, and the iPhone segment and international markets have been growing phenomenally. So I think Apple should have a great year, but as with everything, there's a time to buy things and a time to just hold. In my opinion, Apple is a time to hold. Moving on to AMD right now. AMD getting rejected at resistance, call it 230 down about 215, like these guys right here, prior resistance, and for a while that was support, and right now this is exactly what you're dealing with. So in the event that AMD is not able to continue this push and mount above and change the daily uptrend, well, they have a chance to do it down here, right? Maybe, just maybe, we'll be able to change the uptrend and get a little bit more momentum to crack through that resistance range. Even though AMD is low right now, the stock is quite cheap, and if we do revisit these low $200 prices, you might find me selling some put options down here, 190 into our actual support range, which is, you know, all of these guys from previously. 190 down about 179 is the area that I enjoy doing that. Still a decent time to accumulate some AMD shares here through that lower, 180 segment. In terms of the valuation right now at 210, it's under a 1 peg. It's under a 1 peg, and a 7.28 forward price to earnings. Revenue growth and EPS growth are phenomenal, and I keep bringing this up every chart, every time that I can. Excuse me, every video I keep bringing it up. The big growth for AMD, guys, comes second half of this year into the next few years. Okay, so we're not late to the thesis at all. If anything, the thesis is just starting. Moving on to Amazon right now. Amazon down about 0.84%, not able to shake off the post-earnings decline. We're currently trying to hold on to the support range right here, 205, down about 216. If we drop another level, well, you will be coming down here under 200. 198 down about 190 is the next big pocket of support. Clear loss of the daily timeframes overall. You are daily oversold conditions right now, which means that I love selling put options down here under the $200 range, especially when we're in daily oversold conditions right now. The weekly attempt at the breakout obviously was lost with the earnings flush, and as you can clearly see, right, this is the bigger support level we were talking about into the 26 EMA as well. So Amazon right now, one of my favorite buys in the market by far. Nothing has changed just because they came down 10% after earnings. It's an even better buying opportunity. So I will continue to either play the wheel on it, either continue to buy another leap or so, and possibly just continue to accumulate some shares down here. Phenomenal company, guys. 1.35 peg on a forward basis. Nothing wrong with the business. Moving on to Google right now. Google down about 1.78%, and Google has also been losing ground progressively, right? Formerly, since the rally started in July of, well, I mean, it started earlier than that, but from this period of time, from July, right, we hadn't really lost on the daily timeframes. You haven't really had any big closes below this 26 daily EMA. The reason that matters is because that's your short-term momentum. And now, as you can see, we've been challenging the 50-day EMA, which we haven't done in a long time. So yes, the earnings candle, we're trading within the earnings candle right here, but be mindful of the fact that Google just somehow, just sometimes needs to consolidate, right? You can see the legs here are very big, smaller, 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 and now you might just be looking for the rollover. In the event you roll over, you're going to need a lot of these other tech names to support Google's rollover by moving higher, because Google's a $4 trillion company. If they roll over from this overbought weekly RSI, you can see the weekly MACD also curling over right there, and you can see the time frame starting to show a little bit of weakness here. If they go for their monthly consolidation, it would be very healthy, and the next target for me would be under 300, probably closer to 280 to 270 where the 12 EMA is. So please keep that in mind. There's nothing wrong with this business, but I've been saying up here, guys, that Google is just not my favorite trade. The risk to reward profile is not there for me. That being said, I'm not selling any shares. I'm just not buying anything. It's just a pure hold, and I'm not looking to swing trade up here either because it is a bit extended. Moving on Meta right now. Meta, I mean, another day of kind of inside trading with yesterday's candle on Meta. So nothing really to report. We haven't really changed any time frames right now. We're looking to go for the daily uptrend continuation, but this was a very big earnings give back move, you got to admit. Above resistance, they came below it again. 705 down to 680 is the resistance range, and below support stays put 645 to about 628. Come down there again, guys. It's once again going to be time to buy shares. I mean, not that it's not right now. Around 660, it's a 22 forward PE. It's a 1.17 peg, right? They pay a decent, they have a decent price to sales metric as well, 6.71. So there's nothing wrong with this business at all. And they're guiding for 30% growth. Like, that's insane, with insane net margins as well of 38%, right? But obviously, a lot of the emphasis recently has been on the CapEx spending from the big tech players. So please keep that in mind, guys. If you do come back down there, I'll be trying to sell some put options in the low 600s, but also just accumulating more meta shares. I mean, the time frames haven't really changed much. The bulls are still just trying to go for the weekly uptrend recapture, and the monthly is still trying to establish these monthly lows to essentially try and go for the big monthly upswing recapture right here. Monthly uptrend has not been lost so far on Meta. Moving on to Microsoft. Microsoft also still a little bit weak today in terms of price action. Microsoft was up 1.5% at the peak of the day. It kind of gave it all back into the close. So they're still trying to shake off this post-earnings move right now. We are above a key area of structure, which is this whole 410 down to roughly 385 location. Phenomenal area to be buying Microsoft, but you do need the bulls to kind of change the trend if you want to say, okay, sell-off is done, oversold conditions, and now we might be looking to possibly change the weekly trend over the next few weeks and months as well. So please keep that in mind. As of right now, Microsoft is a couple things for me. It's very nice location to be buying leaps. Very nice location to be buying shares, and selling some put options under the market as well could be very lucrative. It's very close to the 200 weekly EMA. Microsoft never comes down here. The Ford valuation is quite compelling as well. 25 Ford PE and a 1.34 peg. So most of these earnings, guys, we covered them in the last 2 weeks, but if you haven't seen any one of them, highly suggest you go back and watch my videos as to why I enjoy these companies so much. Moving on to Netflix right now. Netflix actually tried something today and they just got rejected. Netflix rallied 3% at the open. Gave it all back throughout the day, but they're trying something. What are they trying? They're trying to peek their heads above the infamous daily 12 EMA, and they haven't been able to do that since December. It's been a very long time that the bears have just been grinding us lower on this 12 EMA. So pay attention to it. If you do get a push above and a trend change, that is going to change structure that we have not seen in a few months. They're also trying to find a local bottom here, maybe on the weekly. If not, we're coming right back down here to 175, 200 weekly EMA. We are at weekly oversold conditions, but perhaps it's an attempt to change some of the short-term momentum and change some of these short-term trends. That being said, no trend change for now. The bears still control almost everything around 83 bucks, guys. The valuation is still very supportive for some long-term buys. 26.5 forward multiple, which gives you a 1.33 peg. Moving on to NVIDIA right now. NVIDIA down about 0.79%, still just barcoding, man. Just doing absolutely nothing, right? Huge recapture of the move, right? The most recent selling move. And now, maybe once again, we backtest 185 to 177. If we do come down there again, you guys know me, I'll be looking to sell some put options in the mid to low 170s, looking to accumulate a bit more of a share position too. But right now, nothing to report on NVIDIA. It's just stuck. Let's be honest, right? It's stock, but what's it doing? It's accumulating, in my opinion, accumulating with a bullish bias. It's just a monthly accumulation process. The 12 EMA keeps curling up higher, so pay attention. We got a couple nice support zones to play off of, right? 185 to 180, and then below 170 down to 160. So very key areas of structure. NVIDIA earnings next week. Moving on to Tesla right now. Tesla, very strong day from Tesla, got to admit, right? 2% to the upside, reacted perfectly from our support zone down there, 405 down to about 382, and now we're trying to challenge this slight little interim level, which is the infamous 415 up to 430. If they can get it done, we're trying to do a few things right here, right? They're trying to change the daily downtrend as well, because it's been a daily downtrend for, well, let's just say a long time, since December, right? So we're trying to get something done here. We're trying to go for a somewhat of an engulfing move and change the trend, get the daily uptrend back, possibly put a bottom on the weekly right here as well, and possibly make an attempt for a monthly higher low. Now, you may not see it, my apologies, because the line is in the way right here, but you can see that candle wicked right down into the 12 monthly EMA. And Tesla bulls have done a good job of defending this 12 EMA for the longest time at this point, the last 8 months, let's call it. Monthly consolidation might be looking for the infamous monthly upswing, so please keep that in mind. Tesla, not looking too bad here at all. Now moving into a few names to the bottom half of the list right here. Palantir down 2.38%. At one point, Palantir was down over 3.5%. Now, a lot of people will tell you that, and I was the first person to say this, right? Well, not the first, but you know, we all knew it. Palantir, the only reason that you could possibly find that it's coming down is because of the valuation. It's not because their revenue growth and EPS growth isn't very solid. It's not because Michael Burry, posted a head and shoulders pattern on X. I mean, I assume he's late to it because we were kind of talking about that like, about a month and a half ago at this point in time. So keep that in mind. But let's just be honest. The price action has not been in Palantir's favor recently. It's a daily downtrend. It's a weekly downtrend. It's a monthly phase of consolidation overall. So please keep that in mind. If you are an investor in Palantir, the things that go up very fast eventually do need to have some elongated pullbacks. Are the pullbacks warranted? Well, in terms of the technicals, yes. In terms of the fundamentals, you can make an argument to yes as well. Doesn't remove the fact that Palantir is a phenomenal company and probably my favorite pure play AI name in the market, favorite software company in the market overall too. That being said, you got to start by changing your trends, right? Give me a daily uptrend. Then we can say, all right, then the end of this weekly move is more than likely. And then you need to get your weekly uptrend back. And only when you get your weekly uptrend back can you say, okay, this is your monthly lows. Look how long it's taken on Meta to try and do that whole segment, right? To go from the daily uptrends to trying to go for the weekly uptrends to setting the monthly lows. It takes a long time for that process to happen, right? The lower support range down here is about the whole 130 down about 115. Palantir, decent little pickup down there if you have a long-term time horizon for the business, but no short-term swing trades for me, at least not on Palantir right now. Moving on to SOFI. SOFI, another challenging day for SOFI. They were up today at one point to a high of almost 22, came down about 0.8% on the day. And that being said, SOFI is once again another name where the bears control the short-term time frames, right? So daily downtrend, it is also a weekly downtrend as well, as you can clearly see, right? The year weekly downtrend, and then also a phase of monthly consolidation on good old SOFI. Now, there's a few things at play right now, which is the fact that you broke through this whole 25 to lower 20s to the downside. So one can make an argument that you may just be looking to backtest this as resistance before maybe making a true move lower. I'm a fan of buying SOFI around 20, but also saving some capital in the event it comes down to the lower 17 to 15. I'll be adding some more shares there as well. We're bouncing out of daily oversold conditions. I mean, it looks like they're trying to establish something, but keep in mind, right? That was a very big and violent move from the post-earnings move right there, and you haven't recaptured much of it so far. So you really need to give me the daily uptrend shift for me to be able to say, okay, your weekly lows are probably set, and maybe we have some form of a tradable local bottom. For now, SOFI just still in its bottoming out process, but the valuations down here still quite compelling, right? It's a forward 1.11 peg. Moving on to Uber right now. Uber down about 0.55%. Same concept as a lot of the other stocks on this list. Uber just unable to catch a bid, right? They tried to go for the daily uptrend, they had it, and then slow erosion, and then the earnings flush, right? So daily bears in full control right now. The weekly bears are in full control as well. So keep that in mind. It is a weekly downtrend. It is also a monthly downswing. So a lot of these companies are the same, right? Daily downtrends, weekly downtrends, monthly consolidation phases, and you're just looking for them to slowly start reversing all of those time frames one by one. But during this reversal process, this long consolidation process, we're finding some phenomenal opportunities. And in my opinion, Uber is one of them. Bottom end of the support range down here is roughly 70.59. And at the current valuations right now, Uber is a 422 forward PE and a 1.11 peg. So Uber, I will be adding to this position. I haven't added to Uber shares in a while, and I would not mind adding to the position here and also playing the wheel. I've been starting to play the wheel on Uber down here in the 70s. Obviously, we can possibly fall down here in the 60s in the event that the indexes sell off more, but that would probably be final resting place for Uber if they actually go for that full retracement. Now, moving on to lastly but not least, TSM. So TSM today, up 1.83%. Strong performance by TSM overall. That being said, nice engulfing move. This is a beautiful trend, right? Nice engulfing move. Possibly, if we do have a pullback here, looking to set the higher lows into the 343 range, 330 range again. Weekly, confirmed weekly uptrend. So TSM never lost the trend. There's some companies out there that never lost anything, right? TSM is one of them. Very solid move right there. And the monthly just continues into this monthly extension, which is why it's not my favorite trade to start a position in right now, either for swing trading purposes or long-term portfolio position purposes, right? The valuation is not that steep. I mean, at 360, we did it at 340. At 360, it's probably like a 28 27, 28 forward PE. It's probably closer now to a 1.45 peg. So the metrics aren't terrible. Price to sales is also now closer to a 10 than before. So it's not terrible. I mean, TSM is TSM at the end of the day, right? But there are moments in time where it is a better idea to buy TSM than other times. And usually those times do imply consolidation periods in this stock, right? So if for ever which reason we find TSM pull back here again, then I would be a fan of possibly adding to the position or looking for some swing trades. But now I'm kind of just fine holding everything that I have. It's kind of like Apple, right? Even though TSM isn't overvalued really by any metric, it's kind of like Apple. I'm just not adding to it, right? TSM is just a hold for me. And that is everything, guys, for today's video, I think, because now it's about an hour and 20 minutes long. I apologize. I was hoping to cover more stocks here, but I guess we'll just have to do those tomorrow, as tomorrow I'll probably only be covering 2 companies for earnings. I think tomorrow I might just do maybe Shopify and AppLovin or something like that. I know there's many more, guys, but, tomorrow I'll probably try to focus more at the end of the video here on the biggest gainers and losers of the day. But we covered most of these yesterday anyways, or in the past few days. So you guys probably know my thoughts on all these themes, all these stocks. None of them have changed overall, right? Even though there's tons of names on this list, it's all the same common theme. So we'll probably talk about them more tomorrow. So, but that'll be it for today's video. So in the event you enjoyed today's video, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Would love to have you back. We do these videos every Monday to Friday after the close, but now Monday through Thursday while I'm traveling. And last but not least, if you guys have any questions, or if you guys are looking at specific stocks, definitely feel free to leave it down below in the comments section, man. Love hearing from you guys. As always, my pleasure in making these videos. I know they're long, but hopefully they are educational and that they give you guys some good information as well in the context of everything we could possibly find in the market. So that's it for me, guys. Take care. I'll see you guys tomorrow. Have a good day in the markets. Non-farm payrolls. We'll cover all that tomorrow. Peace.